This is not an energy story. It only looks like one. What you're watching right now is something far more dangerous, a structural exposure event, a moment when the world discovers they think the danger begins when a producer stops. It does not. The danger begins years earlier, when the world builds an entire economic order on the assumption that strategic supply will always remain cheap, open, insurable, and politically manageable. That assumption is the real fuel of every major shock, because once the assumption breaks, everything built on top of it starts moving at the same time. Freight costs rise, import bills rise, industrial margins shrink, inflation expectations return, central banks lose room, governments lose patience, voters lose trust. That chain reaction is not random, it is not emotional. It is mechanical, and it follows the same pattern almost every time. First, a system builds itself around a strategic foundation and slowly starts treating that foundation as permanent. Then it overextends, debt rises, dependency deepens, buffers disappear, efficiency replaces redundancy. What looks advanced on paper becomes fragile in reality. Then a trigger arrives, a war, an embargo, a revolution, a shipping disruption, a sanctions regime. Something that reveals the foundation was never neutral infrastructure. It was leverage waiting to be used. And then the final stage arrives, repricing, inflation, panic, political stress, institutional improvisation. A transfer of power from the people who assume stability to the people who control the bottleneck. That is the pattern. And if you think that sounds dramatic, history says it is actually understated. Go back to the early 1970s. Most people remember 1973 as an oil crisis. That is true, but it is incomplete. The real story started before the embargo. The United States had built the center of the post-war monetary order. The dollar was tied to gold. Allied economies were linked to the dollar. Cheap energy supported industrial growth. It looked stable. It looked permanent. It looked like the natural shape of the modern world. That was stage one, the foundation. Then came stage two. The United States tried to sustain military commitments abroad, social spending at home, and international monetary credibility at the same time. But systems cannot keep expanding claims forever without weakening the discipline underneath them. By 1971, Nixon ended dollar convertibility into gold. That was the fracture beneath the surface. The monetary foundation had already started cracking before the energy shock arrived. Then came 1973. Arab oil producers imposed an embargo and production cuts after the Arab-Israeli War. And suddenly, the world learned something it had not wanted to price correctly. Energy was not just an input. It was strategic leverage. That was the trigger. And then came the outcome. Inflation surged, growth weakened, confidence in policymakers fell apart. The public saw gas lines, but the deeper system saw something worse, loss of control. That is why stagflation was so destructive. It was not just high prices and slow growth. It was a public demonstration that the old architecture no longer worked the way people thought it did. And here is the key lesson. The embargo did not create fragility. It exposed fragility. That distinction matters because it is exactly how big crises always work. Now move forward a few years. If the first shock had truly rebuilt resilience, the second would have been survivable. But that is not what happened. The late 1970s were not a clean recovery. They were a system trying to regain confidence without fully reducing dependence. The economy was still vulnerable to oil. Inflation psychology was still unstable. Policymakers were still trying to prove they had things under control. So the foundation returned, but only as a patched foundation. Then came stage two again. The public hoped the worst was over. Markets hoped supply would normalize. Leaders hoped that previous trauma had been temporary. But unresolved vulnerability is not recovery. It is delayed exposure. Then the Iranian Revolution hit in 1979. And once again, the market repriced more than barrels. It repriced continuity. It repriced reliability. It repriced the idea that a major supplier would keep the system fed simply because the world needed it to. That was the second trigger. And the outcome was even harsher because the denial had lasted longer. Inflation surged again, confidence fell further, and the eventual response became brutal. Paul Volcker's rate shock did not feel like a gentle adjustment. It felt like forced stabilization through pain, recession, unemployment, debt stress, a hard reset of expectations. That is the second lesson of the pattern. If a system survives the first shock without rebuilding slack, the second shock lands harder, not because the event is bigger, but because the system is weaker. Now jump to Europe after Russia's invasion of Ukraine, because this is where the modern myth collapses. For years, Europe built an industrial model around Russian pipeline gas, cheap enough to support factories, steady enough to support planning, normal enough to feel permanent. That was the foundation. Then Europe optimized around it. Supply chains leaned on it. Households leaned on it. Competitiveness leaned on it. Transition plans leaned on it. Dependency started looking like efficiency. That was overextension. Then the trigger hit. Russian gas flows plunged. Governments scrambled. LNG cargoes were redirected. Gas prices surged. Emergency interventions followed. The market stopped behaving like a quiet utility market and started behaving like a battlefield. And then the outcome arrived. Higher costs, slower growth, a cost of living shock, a blow to industrial competitiveness. Europe did not just pay more for gas. Europe discovered that part of its old economic model had been built on a geopolitical condition that no longer existed. 3 eras, 3 different political settings, same pattern, foundation, overextension, trigger, repricing. Now look at the present. The global economy enters this moment in worse structural condition than the system that faced 1973. Global debt is around $345, $7 trillion, roughly 310% of global GDP. Governments are more indebted, consumers are more inflation sensitive, corporations are more financing sensitive. Central banks have less room to make mistakes. That means the world is already fragile before the shock fully matures. So stage 1 is already in place. The modern world has built itself around concentrated energy transit, ultra-optimized trade, and the assumption that rerouting is always possible if enough money is thrown at the problem. That assumption is weaker than it looks. Then comes stage 2. The system is optimized around concentration so aggressively that resilience has become expensive and therefore politically unpopular. Qatar sends more than 80% of its LNG exports to Asia. China and India rely heavily on it. Europe may take a smaller direct share, but LNG is global. If a giant balancing supplier stumbles, nobody stays local. Cargoes move, prices spread, somebody gets displaced, somebody pays more, someone runs short. That is what concentration means. It means the map on paper is less important than the chain reaction in the market. Then stage 3 arrives. Qatar halts LNG output. Hormuz becomes a genuine risk zone. Insurance tightens, shipping confidence breaks, benchmark prices explode. Atlantic cargoes begin chasing Asian premiums. That is not a scare headline. That is the trigger functioning exactly as the historical pattern says it will. And now stage 4 begins to come into view. Not fully, not yet, but clearly enough. If disruption persists, the first wave is energy pricing, the second wave is industrial pain, the third wave is inflation psychology, the fourth wave is political stress. And that is why this may be worse than 1973. Because the older system was less indebted, less financialized, less dependent on continuous global optimization. Today, the world runs on thinner, slack, and bigger promises. Governments promise stability with less fiscal space. Central banks promise control with less room to cut or tighten safely. Consumers expect relief with less savings. Industries depend on just-in-time flows with less tolerance for interruption. That means a supply shock no longer lands on a strong machine. It lands on a machine already vibrating. And once a system like that gets hit at the choke point, the issue is no longer energy alone. It becomes a credibility event. Can governments still protect purchasing power? Can central banks still manage expectations? Can Europe refill storage without paying a punishing premium? Can Asia secure cargoes without detonating affordability? Can markets still price risk rationally when insurance, shipping, and supply are all moving at once? That is what the market is starting to ask. And here is the coldest part of all. The upstream bottleneck still rules the downstream narrative. Not market capitalization, not political speeches, not technological optimism, not the fantasy that size automatically equals control. The world still answers to whoever can interrupt what it cannot quickly replace. That is the real meaning of Qatar playing the ultimate card. Whether it is framed as strategic leverage, forced shutdown, or the brutal logic of geography, the conclusion is the same. Modern power still hides inside material choke points. And once that becomes obvious, several myths start dying very quickly. The first myth is that America is insulated. It is not. The United States may have more domestic energy strength than many of its allies, but pricing is global, shipping is global, and inflation expectations do not stop at borders. If Europe pays more, Asia bids harder. If Asia bids harder, cargoes move. If cargoes move, relative prices shift everywhere. No reserve currency cancels that chain. The second myth is that modern policymakers can smoothly manage any shock because they have seen it before. History says knowledge does not repeal structure. A debt-heavy, politically polarized, supply-dependent system does not have elegant choices in a real bottleneck event. It has bad choices, delayed choices, and expensive choices. The third myth is the technology myth. Technology matters. It helps. It improves routing, forecasting, coordination, efficiency, but it does not instantly create liquefaction trains. It does not reopen a threatened strait. It does not restore canceled maritime insurance. It does not stop industrial users from paying more next month. You cannot code your way around missing molecules in transit. So what should the viewer actually take from this? First, stop reading these events as isolated headlines. An LNG disruption is never just LNG. It is inflation. It is industrial cost. It is trade stress. It is fiscal pressure. It is political exposure. Second, learn to identify the pattern early. Ask 4 questions every time. What is the foundation? Where is the dependence? What is the trigger? Who controls the bottleneck? If you can answer those 4 questions, you will understand more than most of the commentary you're being fed in real time. Third, watch duration, not just shock. A one-day spike is fear. A 2-week disruption is strain. A multi-month disruption is repricing of the whole system. That is when temporary rerouting becomes structural realignment. That is when the old baseline dies. And fourth, understand that resilience is now worth more than confidence theater. Resilience means flexibility, liquidity, lower dependence on perfect macro conditions, respect for strategic commodities, respect for supply chains, respect for the fact that the cleanest looking systems are often the weakest when flow is interrupted. Because collapse almost never begins where the public is looking. It begins where dependence has been mistaken for order. It begins where efficiency has erased slack. It begins where leaders talk most confidently about stability. It begins where markets stop pricing contingency because contingency has become inconvenient. Then one disruption appears, and suddenly everyone remembers that civilization is still built on choke points. That is why this is not just another Middle East scare. It is a live test of a world order built on debt, concentration, and optimistic assumptions about continuity. History has seen this machine before, in 1973, in 1979. In Europe's gas crisis, and now again, with a more indebted and more brittle global system staring into a strategic energy interruption, it cannot dismiss. So no, this time is not different, the language is different, the contracts are different, the infrastructure is different, the analysts are different, but the mechanism is the same. Foundation, overextension, trigger, repricing. That sequence keeps returning because systems keep making the same mistake. They confuse access with control, efficiency with strength, and temporary flow with permanent order. And when reality arrives, it always arrives through the bottleneck. So do not waste time waiting for reassurance from people whose entire worldview depended on uninterrupted stability. Study the architecture instead. Study the choke points. Study the dependencies. Study the hidden places where real power still sits. Because the people who understand the structure early do not panic. They adjust. The people who understand it late become the adjustment. And that is the real warning here. The world is not just watching an LNG disruption. It is watching the price of false certainty. And if this interruption deepens, the next phase will not be about whether the shock is real. It will be about who absorbs it. Watch the cargoes. Watch the insurance market. Watch European storage. Watch Asian bidding behavior. Watch inflation expectations. That is where the next chapter will reveal itself. And if you want the next video, we go even deeper into the one question that matters now. How was this machine built in the first place? Because once you understand that, you do not just understand this crisis. You understand the next one before it arrives.